One of the most common questions I get about the wheel option strategy is people want to know, can they start the wheel by selling the covered call first rather than the cash secured put? Well, let's discuss. So, should you start the wheel with a covered call? But before we answer that question, let's quickly recap what the wheel option strategy is. Well, the wheel starts with you selling a cash secured put. So you sell a short put and it's cash secured, meaning you set aside some money planning on taking assignment of the stock should you get assigned on the put. And if you get assigned on the put, then you buy 100 shares of stock. You're now long 100 shares of stock, and then you turn around and sell covered calls against your 100 long shares of stock, and then you keep selling covered calls until you get assigned on your call, and that means that now you have to sell 100 shares if assigned, so you're back to having no shares, and then you start selling cash secured puts again until once again you're assigned 100 shares of long stock, yada yada yada. The wheel just keeps on turning. Now, because obviously this wheel is a circle, right? Do you necessarily have to start with the cash secured put? Why can't you start at the bottom half of the wheel and sell the covered call until you're assigned and you get your shares called away and then start the cash secured put? Why can't you start here instead of here? Well, let's discuss. First, let's talk about short puts and covered calls. So a short put is a put option that has been sold rather than bought. A short put is a bullish strategy because you want the underlying price to go up. You want the underlying price to increase, or at the very least, you don't want it to decrease. Typically, when you sell your puts, kind of like this example, this is an out of the money put, meaning I sold it below where the stock is currently trading. So really, I don't necessarily have to have the stock go up. I just can't have the stock come down too much. The break even on a short put is the short put strike price minus the premium received. So I've got a little bit of a cushion here to the downside. That cushion is that premium I received when I sold the put. But once I get past that break even point, then I start losing, and I start losing in a big way. So this is a undefined risk trade, meaning that I could potentially suffer a catastrophic loss on a naked short put. So the short put here, I have a limited reward, the credit received is my max possible reward, and I have an unlimited potential loss. Now, technically speaking, that unlimited loss on a naked short put, it's not truly unlimited because a stock can only fall to zero. But most stocks, if they fell to zero, it would be such a catastrophic loss. It would seriously damage, or in some cases completely wipe out your trading account. So we consider a naked short put a unlimited loss trade or an undefined risk trade. Now let's take a look at the risk profile for the covered call. And a covered call, of course, is you have 100 shares of long stock and then you sell an out of the money call against it, typically out of the money. Or you could sell it at the money or even in the money, but for most people, you're going to sell an out of the money call like I have in this example. And it's essentially very much like that short put that I just showed you, because this is a bullish trade, and as long as the stock finishes above my short call, I receive the max possible reward on the trade. And if the stock finishes lower than my call, then I start winning a little bit less until I get to a break-even point, and then I start realizing potentially a unlimited loss. Now look at the risk profile on the covered call. Now let me go back and show you the risk profile on the short put. Do you notice anything similar between the two? It's the exact same risk profile, right? Essentially, the cash secured put, or just your plain Jane short put, it is exactly the same essentially as a covered call as far as their risk profile. There's really no difference between the two. And because of that, naturally, you would assume that you could very easily start the wheel with the covered call just as you could with a cash secured put. And there is some truth to that, but there are some differences we need to talk about. But first, let's talk about the similarities. Cash secured puts and covered calls are very similar as far as their risk profile. Their risk profile is essentially the same. Both are long delta trades and both are short vega trades. Now, where the differences come in is typically your covered calls are going to have much more long delta than your cash secured puts. And that's because you have long shares of stock that's part of that covered call. Those long shares of stock, that 100 shares of long stock, that's actually 100 long deltas that's a part of that covered call trade. So typically your overall delta on a covered call is going to be much higher than it would be on a cash secured put. So because you have more deltas on that covered call compared to your cash secured put, you can potentially make a greater profit on a covered call compared to a cash secured put. So again, why not start the wheel with the covered call since it has a greater profit potential? Well, the covered call has one big problem. It uses a lot of buying power, and that's because it contains those shares of stock. Shares of stock are expensive. They're very expensive. And I can show you this in action. Let me switch over to TASTYTRADE, and the market is open right now. And let me show you a potential cash secured put in some stock, and then I'll show you the same kind of covered call strategy in that same stock, and I will show you the difference, especially in buying power. So I'm going to use Amazon because it's a nicely priced stock at $180 a share. And let me go in here, and I'm going to go, well, I'll go to the 73-day cycle. So, about 73 days out in time. And for me, typically I would sell a put somewhere around the 30 delta mark, for example. So let's go and sell this 30 delta put. So in this case, I would receive $545 on a buying power reduction of $2,400. My probability of profit is going to be 73%. My total long deltas on the trade are 30 deltas, right? Because it's a 30 delta short put, I've got 30 long deltas. So this thing is going to be very similar to had I just purchased 30 shares of Amazon stock. Now let me switch over to a standard kind of covered call. So instead, let me now do a covered call. So I'm going to purchase 100 shares of Amazon, and now I'm going to sell a 30 delta call. The closest I can get is a 29 delta call, but that's very close to that 30 delta short put that I was selling earlier. Now in this case, I have 30 short deltas on the call, but I have 100 long deltas on the 100 shares of stock. So overall, what am I long on the trade? Well, I'm long 70 deltas. I have 70 long deltas on the covered call compared to the 30 long deltas I had on selling that 30 delta short put. So this is much more directional, right? This is much more of a bullish trade. Now, because it's more directional, there's more risk to the trade. I'm going to get paid more potentially on this trade. Now, I have to pay a debit, obviously, for the overall trade here on the covered call. I have to pay $17,700 overall for the shares minus the premium that I receive on the call. So a little more than $17,000 here. But I have a max profit potential of nearly $2,300. Now, the max profit I could have made on that short put earlier was around $540, right? So instead of $540 max profit, I now have about a $2,300 max profit. So my max profit went way up. But you know what else went way up on this trade? Because it's got a little bit more risk to it. My buying power went way up. So instead of having like a $2,400 buying power or whatever on the put, I have a $8,600 buying power on the covered call. So, that's the trade-offs, right? So the cash secured put and the covered call, they're very similar trades as far as their risk profile. But because of that difference in delta as well as that difference in buying power, there's some differences between the two that you need to be aware of. So between the cash secured put and the covered call, which one is better to start the wheel? Well, to me, I don't think there's anything inherently wrong about starting the wheel with a covered call, but that buying power requirement really does make it less than ideal. It makes it less ideal than the cash secured put. Also, because your cash secured put typically is going to have less long deltas, much less long deltas than the long deltas on a covered call, it makes it really less of a risky trade. It's and of course you can size your cash secured puts to take more risk. You can buy more puts, you can buy more contracts or whatever, but because inherently it's a little bit of a smaller trade, to me, cash secured puts, they're much more flexible, much more scalable. In my opinion, it's actually the short put that is really the magical part of the wheel. That's the part of the wheel that you really want to spend the most time on. You want to be selling these puts over and over and over again and collecting as much premium as you can with spending as little buying power as you possibly can. You're going to get greater return on your capital that way. The only time you really want to be selling a covered call while you're wheeling is if you get assigned the stock. If you get assigned the stock and you have the shares of stock now, obviously you want to get out of the shares of stock. Well, then you sell the covered calls, mainly in an effort to get out of the stock. Also to actually profit a little bit. You hope to win on the covered call, but you also want to get out of those expensive shares of stock so you can get back to selling cash secured puts because, again, for me, that's really where I want to be when I'm running the wheel. Now, that said, if you want to start running the wheel on a stock where you already own shares of stock, yeah, it makes sense to sell the covered call to start the wheel because you already have the stock anyway. Makes perfect sense. But if I don't already own shares of stock, then in my opinion, I think selling cash secured puts to start the wheel is always preferable to selling covered calls. But it's not just the buying power that makes me prefer cash secured puts over covered calls. It's also a little bit of risk management, because imagine the underlying stock drops really hard. Well, in the case of the cash secured put, if I sold an out of the money cash secured put, well, now I get assigned, I have to purchase shares of that underlying stock, but I get to purchase those shares at a steep discount. And I'm not unhappy about that. No, not necessarily. But on a covered call, if you start the wheel with the covered call, you're already buying 100 shares of the underlying stock at the price it's trading at today, minus a little bit of a discount, because you get a discount because of the call premium associated with the covered call, but it's just a small discount on the share price. So in the case where the underlying stock has a serious drop, where it really drops hard, you're going to get hurt much more on the covered call than you would on the cash secured put. So there you have it, some of my thoughts on starting the wheel with cash secured puts versus covered calls. Now, is there a wrong answer or a right answer to this? Not necessarily. A lot of this was just some of my thoughts, some of my opinions. If you want to start your wheel strategy using covered calls rather than cash secured puts, I don't think it's necessarily wrong. Again, just know that there are some differences between the cash secured put and the covered call. Now, if you'd like to learn more about my favorite option strategy, which is the wheel strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. You'll find a link to this book in the description below. Also, if you want to help support this channel, please consider subscribing to the DT Options Discord server. I hold a live 1-hour trading session there every trading day for the first hour that the markets open each trading morning. We have a little discussion. We've got a nice little trading community there where people get to see what I'm doing with my trading. We talk about potential trade ideas and what the market is doing that day. Also, over on the DT Options Discord, you'll find all the PDF slideshows from all of my videos, including the PDF slideshow from this video. Peace, guys.